welcome everybody. You're in for a treat. I'm really excited to have the opportunity. Welcome, Austan. It's great to have you here. Welcome to Indianapolis, which of course you're familiar with. So yeah. Lumina's been a privilege to have Austan on its board for a number of years, and he's been a significant contributor. And before we get into sort of the substance of some of the things that we might talk about today, I wanted to begin by asking you a little bit about you. And you know, you've been a professor at the University of Chicago for 3 decades. You obviously had a stint in politics. What brought you to the Fed? And say a little bit about the pathway to the role.
Thank you, Jamie. Now I'm regretting, I've been on the Lumina board for a lot of years, and I can be an ornery board member. Now I'm regretting all of the stuff. Jamie's like, oh, it's payback. And we've got the former president of the St. Louis Fed here, now a member of the, and I used to give Jim Bullard, I used to give a hard time. We sat next to each other at the FOMC meeting, though he was a lovely mentor and help as I came in. And let me just say, what a fine and persuasive public speaker you are, Jim. Like when he took the job here as dean of the business school over at Purdue, he went on to tell me, now I'm your constituent. You work for me. You know, you're going to answer. So I came to the Fed, as you say, I'm a research economist. I got out a PhD. I had never spent time in the Midwest. I got a job at the University of Chicago. I went there. I fell crazy in love with the university, with the city, with the region, and never left. I'm the source of the static here. Hold on. I knew Barack Obama, who taught at the law school. When he was first running for the U.S. Senate, I would contribute some economics to what he was doing. I helped him on the campaign. I went and worked in the administration for about 3 years at the beginning. I went back to being a professor. But the mission-driven nature of policy work, I definitely miss that. I love academics. I love the brilliance of the people, the thinking. It is also the case that every week in academics, you're like, but no one cares. Why are we even doing this? What difference does it make? And you never had that feeling. For all the frustrations of public service work, it always mattered. When I was there was the financial crisis, so it was definitely high stress, but I kind of missed that part. And the Fed system is, so if you're an economist, if you're kind of a econ gym rat, the FOMC, where they set the interest, that's about the coolest thing in the world. And so there's mandatory retirement at the Fed at 65. So the previous president had to retire, and it seemed like a mission-driven organization with a foot in economics, and I didn't have to move. And so I applied for the job, and it's been wonderful. I mean, it's really a privilege, as you say, of running a foundation, to be involved. Even in the Fed's part of the universe is narrow, but it matters a lot in this part of the universe. And the people, the Chicago Fed's 1,800 people or so, they're believers, and I mean they know the mission. And as I say, we're not the bad guys. We're the guardians of the galaxy, you know, and the good ones, not the raccoon. Like so it's really been something.
Maybe one more just question about you before we get into the sort of where we are in the world right now, which is, so everybody here obviously is very familiar with the Fed and what the Fed does and its role, but what does a central banker do? What do you do? Like, what is your role in this system?
This is what I might have put to Jamie. What do you do all day?
Do? Yeah, that's right.
Yeah, okay, so you're asking me.
Yeah.
I kind of say there's 4 parts of the job, and each one is 1/3. So one part is monetary policy. Every 6 weeks, go to Washington, we sit around a table, the shades come down, so there's no spying, and they go around, and the presidents and Jay Powell and everybody, they're going to give their opinion of here's where we are in the economy and here's what we think we should do with interest rates. Two, permit me a brief diversion of how the Federal Reserve System is set up. The FOMC was created in the Federal Reserve Act. The Federal Reserve Act is from 1913. In 1913, as today, people were deeply uncomfortable with banks in New York City plus government in Washington, D.C. running the entire financial system of the United States. So they created a system which, it's a little bit kludgy, but you've got some political appointees that are governors and a chair in Washington. And you've got 12 reserve banks from out around the country that have a region, and the 7th District, Chicago Fed, is basically most of Iowa, Illinois, Indiana, Michigan, Wisconsin. Heart of the Midwest, that's the district. And they're not political appointees, they have a board, and they're chosen by a collection of business and civic leaders in their from their regions. Those reserve banks have a role in bank supervision, that they're the regulator and overseer of a bunch of banks. Is the second one. The third is we provide financial services to our member banks. We're kind of like your bank's bank. And that includes we run a bunch of the wire transfer and ACH direct deposit and the new FedNow payments rail and cash for the ATMs. We got a giant vault. Jamie has seen it. Tens and tens of billions of dollars of cash in there, and we run hundreds of millions of dollars a day to banks who say, I need money for my ATM,
There's no
et
gift
cetera.
shop at the end.
And they said, were you handing out money? Yes, but it's shredded. And then the fourth category is engaging with our districts, community development, going around and seeing factories and services and interacting with the business community and civic community, partly for our knowledge, because what you see at your places of work is more current than the data, which come out with a lag of a month or a quarter, et cetera, and partly tell them the Fed story, who we are, here's what we do, we're not the bad guys, let's demystify it. So between those four things is how I spend my time.
Fantastic. Well, let's talk a little bit now about sort of where we are right now. I think every year I get to Q4 and I think, man, that was a crazy year. And I feel that way in 2024. But what's your look back from your current perch on 2024? Like, how did we do? And where are we as we're getting to the end here of 2024 from your Fed perspective?
It's important. I was going to say the Federal Reserve Act creates what we call the dual mandate, right, which it's not easy, but it's straightforward. The Fed is supposed to set monetary policy to maximize employment and stabilize prices. And we publicly interpreted stabilizing prices means getting the inflation rate to 2%. Okay, so that's our job. I won't say it's our only job, but on monetary policy, that's our only job. By dual mandate grounds, 2024, especially 2023, but 2024 was pretty outstanding conditions on dual mandate grounds, which is in 2023, the inflation rate was out of control coming in out of COVID, and we cut the inflation rate by almost as much as it has ever gone down in a single year without there being a significant recession, which is largely unprecedented. So I started calling that the golden path. I was like, 2023, they're going to remember that will be studied for a long time. And I added, and now if we screw it up, that's going to be studied for a long time too. 2024 began with a little bit of a bump in the road. The inflation rate came up a bit, but I think that proved to just be a bump in the road. If you take the long arc, inflation is down a lot from its peak. The job market cooled to something now that feels close to stable full employment, let's call it. The dual mandate looks pretty good. You'd like to kind of keep it in that, get the inflation to about 2%, unemployment about where we want it to stop. And that's what makes me think that over the next 12, 18 months, what the thing that has to happen is the interest rate has to go down to where we think it should be settling, just like the other conditions have settled. We raised rates as fast as they've been raised in a single year. We held it at a high level for a long time, and now we've started cutting. And we can argue about how fast that happens, and we revisit every 6 weeks, thinking that through to calibrate. But as I look out at 24, we continue to do on dual mandate grounds pretty well, and I think that it means if we continue on that, the rate's coming down.
I'm interested more in the first of the mandates around employment, in particular, because it seems to me that, on the one hand, the last 2 years are almost historic low levels of unemployment in this country. We've seen a little bit of an uptick in the last few months. So the question is, should we be worried about that? I mean, as you said, we pretty much stuck the landing on the employment side with an incredible landing, in terms of employment. But now there's a little bit of an uptick, and of course that creates maybe some noise in the system, or is it something to worry about?
Some of both. I mean, as I always say, the hardest thing that a central banker has to do is get the timing right when there's some moment of transition. And that's even doubly true when the current conditions look so little like the historical experience, which we went through COVID. It was a business cycle like nothing we've ever seen. It wasn't cyclically sensitive industries like durable goods manufacturing or others that led the cycle. It was literally not being able to go to a restaurant, not being able to go to the dentist, not do a bunch of stuff that's normally largely recession-proof that led the recession. Now we've come out of it. It's very unusual. And getting that timing right means, I think, we got to take this long arc. You can get too into what I call this month-itis, where if you just take the jobs numbers, we had one number in August that was disappointing, and then people started to freak out. Maybe this is a sign that we're about to roll into recession. Then we have a number that's extremely strong, and then some people publicly start to freak out and say maybe the Fed is behind. We're about to overheat again. Then we get another month, which is extremely low, and people say, well, maybe it's a strike and we had 2 hurricanes, and so pay no attention to that number. What you conclude from that, you just want to be careful not to just go off of 1 month's data.
Right.
I think I was nervous and said publicly the job market had to cool a bit because, as you say, it was hotter than sustainable.
Right.
We on our board at Chicago Fed is Chris Murphy. Some of you may know him from Indiana. The very first speech I gave, we went out to Elkhart and toured one of the RV factories, and Chris was telling a story that they could not hire bank tellers at their bank.
South Bend, yeah.
And because they would literally, the RV manufacturers were paying so much, they were having tellers just come in and say, I quit. I could go over there, I could make $35 an hour, and I've never done it before. So I kind of think that was a microcosm of where we were, and it wasn't sustainable. What I said earlier this year was, we got to cool to full employment, but we're supposed to stop there, not crash through it. I've gotten more comfort that we're not crashing through it. If you take a broader measure, not just how many jobs were created for the month, but take the unemployment rate, take the ratio of vacancies to the number of unemployed workers, take a series of broader measures of the labor market. To me, those feel like they're moving into the stable, sustainable, full employment kind of category.
Yeah, I mean, you mentioned the issue of data and how data-driven the Fed is. And one of the things that I think, this is almost like a human behavior question, which is one of the things that's been interesting to me, again, and particularly in recent history, is that it feels like there's this lag between what the data show around things like employment or inflation and how people are feeling on the ground. And so I listen to sports radio. And on sports radio, you know, we sort of hit the very low unemployment rate. And I'd hear these ads for months and months afterwards from these companies saying, you know, unemployment's at record rates, and you know, this is what we need to do. And I was like, no, that's not what's happening right now. And so I'm curious to know, why do you think there is that disconnect? Why is there a disconnect between what consumers know and feel and what we actually see in the data?
What in the vibes? And the vibes just didn't match. So I'm telling a happy story of like, look, the dual mandate, we got the unemployment rate is down barely 4%. Inflation's coming to 2%. We should be happy. And then if people are being asked about the economy, they're like, the economy stinks.
Right.
I don't totally know. I will say a couple of things about this. One, I do think what you read in the media has a direct impact on how you think things are going. And that's not new. If you're old enough to remember the presidential election of 1992, you will remember it was James Carville and it's the economy stupid, and the whole thing was about the mismanagement of the recession. I invite you to go look at the data about the recession of 1992. It does not exist. There was no recession in 1992. The recession ended in 1991. But the media kept saying, look, the recession is horrible, everybody's upset. And that did influence people's view. And now the media environment is everybody can have their own channel. And so I do think that contributes to the politicization of everything. You probably saw in the vibes the day Joe Biden was elected in 2020, the Democrats in consumer confidence surveys, they asked, what's the state of the economy? Whoop, they went way up, and Republicans, whoop, went way down. And now Donald Trump just got elected, whoop, it just did exactly the opposite. So there is a sense in which the law tells the Fed we're supposed to look at the actual numbers. Now, we always cared about the vibes because the vibes were a pretty good indicator of consumer spending, like consumer sentiment told you about consumer spending, business sentiment told you about investment spending. And not in the last 2 years, but over the last 10 plus years, that relationship of being a leading indicator is kind of broken down. So the vibes do matter, but they don't matter as much as a leading indicator. We pay a little less attention to what the vibes say is about to happen and more as a lagging indicator of 6 months ago what happened. And the only other thing I'll say, which everybody knows, is there are a few very public things which have an outsized impact on people's opinions about the economy. The price of gas, the price of groceries have a bigger impact on their view of the economy than they are as a share of the budget. And both of those have at various times had very high inflation, and the price level remains pretty high.
Right. So speaking of data, this is a little bit of a homer question, but one of the things, if I'm reading the data correctly,
A homer question?
a homer question. Yes, I'm a homer for Indiana.
Oh,
I'm
I
a
was
homer,
like, Homer
for
Simpson
Central
or
Indiana.
Homer, the ancient Greek?
Yes, no, that would be a Homeric question.
A Homeric question. Okay.
And if I'm reading this correctly, I believe that Indiana, and particularly Central Indiana, outperformed the Midwest economy. And if that's the case, if I'm right about that, why do you think that is? What are we getting right?
I mean, as you know, Indiana's always had a very favorable business climate, and costs are low. In a period where costs are high, is it me or you? That one might be you.
Yeah, it's always me. Go ahead.
So I do think cost has some factor, but I think the main thing is in the Merisotis land, talent development. And if you look at, there are clusters of excellence, especially manufacturing, biotech, and a series of things that's what attracts economic activity. It's always true, it has always been true until COVID, that manufacturing is one of the most cyclically sensitive of sectors. So, and Indiana is either number one or number two most manufacturing intensive state. So when you're wondering, is a recession about to start? A lot of times people will be like, well, let's go look at Indiana or places that are especially intensive of these cyclical sectors. And if you ask, where are we in the business cycle? You'll be like, well, is Indiana doing well? That's probably a sign that the overall economy is about to do well. While that was always true, that's a little less true right now because, as I say, partly what happened is we shifted away from services and now we're shifting back. So just as an indicator of the business cycle, I don't think it's that. I think it's more Indiana's got high talent, it's got affordability, and it's got a civic engagement component that the corporate and civic communities, as illustrated by you and as illustrated by this room, that directed plan has been helpful. Places that have thought through their growth have done better than places that did not.
Yeah, as you know, I've written a lot about AI and talent, which is a very important priority for us here at CICP, and the sort of changing nature of work. But I'm curious to know what your broader view is of the impact of AI on things like economic growth, productivity, and other things. I mean, I'm involved now in so many more conversations about AI than I was even 6 months or a year ago, in part because ChatGPT sort of finally penetrated the public's consciousness about what artificial intelligence really is, but in part because the applications are getting more and more clear. And the question is, how will that impact productivity and growth?
I was first going to ask you, does that make you nervous? Like, in a way, have we heard too much about it? Maybe.
Yeah.
There has been, in the last year and a half, I don't think it's me, is it? A tremendous upswing in productivity growth. And it followed a downturn at the beginning of COVID. And a lot of people thought, all that's happening is there was a previous trend. I'll do it this for you. There was a previous trend here. We went down. Yeah, we're coming back fast, but we're basically just going to get back to the rate of innovation that we were on before. We still might, but just so everybody knows, we passed it. Okay, so the thing got steep, and we're above the pre-COVID trend in productivity. And if that's true, that for some time we're going to have faster productivity growth, that's wonderful. There's nothing better than that. It means we're going to be able to grow faster than we thought without generating inflation. That's not dissimilar to what happened at the end of the 90s. And that's the golden land. And it has implications for monetary policy too. if that's from AI, I have been resisting the thought that that came from AI because AI is still too little.
Yeah.
If you go ask, well, how many companies have adopted AI, and even for the ones that have, how central is it to their business? It's not big enough to explain this. That said, if we are due for an uptick in service sector productivity, which is where a lot of these things are. On our board, for example, is one of the most senior executives at United Airlines. They said they tested all the time in the customer service bots. They actually get higher ratings than humans now.
Yeah,
it used to be
right.
the opposite, and now people are kind of they'd rather go to the bot. I don't know if I agree with that, but that's what the numbers say. If we get a big upswing in service sector productivity, depends how fast, the implications for job creation, but people should basically view that as a huge positive that's going to make us rich. That's how we got to be the richest major economy in the world, is through technological innovation and productivity growth. That means wages can grow faster than inflation and faster than we previously thought they were capable of. So I think it's exciting, but there's still the way back when one of my areas of research was about the rise of the internet, and you'll remember we had a recession in this country that came from a bubble in equities around technology.
Right.
That it wasn't that the internet went away, it was just that it wasn't growing at that same rate forever. And once they found out, it's not going to grow that fast, there was a little bit of air coming out.
Yeah, my quick elevator speech on AI, and we're going to turn to your questions in a few minutes here, but I was at a meeting on Monday in New York with a bunch of foundation CEOs around AI and philanthropy, some combination of fascinating and like watching paint dry, because many foundation CEOs have no idea really what's going on in philanthropy, and some are very advanced. And the gap between the two is pretty interesting. I wrote a book on AI and work, so I guess I'm on one end of that spectrum. But to me, I think part of the issue is that the term AI is being used for a bunch of things, some of which have been around for a while, like predictive analytics is really AI, and robotics is really AI. But what we're really enamored of is the generative AI. And to the extent that the generative AI is going to be transformative, there's much more of a ramp up there than I think people are understanding. So I think the generative part, which is cool and interesting and is having an impact in certain sectors, I think is great. But I think where we're going to really see the transformative delta is when these things start to come together, right? Like when you really get the generative AI and the robotics together, wow, okay, some things are really going to change. And then we're going to be talking about productivity and things like that in ways that we hadn't before. I did want to ask you one more maybe talent question, which is really on the question of the role of higher education in the economy. So, it's long been, in my view, the engine of economic and social progress for the country. The president of Indiana University, Pam Whitten, is here, and I think we share the view here that higher education is more important to the future of the country and to economic growth than it's ever been before, even though there's this pushback and this questioning of value on higher ed, et cetera. What's your view about where higher ed fits in terms of economic growth and overall prosperity?
We've been talking about this for years. The Lumina Foundation been doing it for years. I don't even know how many books you've written on the topic. You've seen the meme of the guy stands up to testify. This is the hill I will die on. Look, I'm going to just tell you three basic facts. There's an ocean of economic literature asking the question, what is the payoff to education? What are the individual returns on education investments? What are the social benefits from people investing in education? Number one, I know people are questioning the value, but the argument that you shouldn't go to college anymore, it's not even worth it. That's totally not correct. If you just look at the data, we had some of it done by researchers at the Federal Reserve Bank of Chicago. Break out for different demographic groups, different regions, all over the place. On average, okay, to have a BA versus not having a BA, that's what we call the college premium. The college premium is as big as it has ever been in history. You earn, on average, $22,000 more per year for your entire prime age and working life, from age 25 to 65. $22,000 a year more. And the net benefit minus tuition is a huge positive number. Now, yes, you can find individual cases where the person majored in something and then got a job that they didn't need to have a college degree for. Yes, that does happen. But on average, that's just not correct. 2, if you look at the price of college, we're used to thinking of the sticker price, and that's not the price that people actually pay. If you look at the net price in the last 10 to 12 years, it's been flat. The real price minus inflation, that the price of college has grown with income and other prices. That's been flat. And in the last 5 years, it's actually been declining. So I think we've had a situation where if you look at a student at the 10th percentile, well, not the 90th, but the 10th, who went to a for-profit college, the outcomes don't look great in that space. But in the space of going to community college, going to a public institution, going to a private four-year college, getting a high-quality credential, on average, these are things that drive the economy. It's the productivity improvement for the individual and the income that they get. I still think we should focus on value. We should focus on why people feel the way they do about educational institutions. But let's not kid ourselves. The data screams out at you. The premium for getting skills is as big as it really has ever been.
Fantastic. Yeah, the new rallying cry should be, it's the talent, stupid, right? Like talent is what really drives.
It's the talent,
right.
stupid.
Exactly.
Yeah, right.
Exactly. All right. Let's open it up to questions. I believe we have microphones. Do we have microphones? I'm going to
skip the microphones.
We're going to skip the microphones, and
okay.
Because we have the webcast, I'm going to repeat the questions.
Jamie will repeat it.
And so let's start with the dean of the group, Jeff Smulyan. Yeah. So.
Austan, you just talked about the value of education. We made a decision in this country 100 and some years ago to provide K through 12 education to every American. Is it time now, given the changing nature of where we are, to think about college education provided for all Americans?
Yeah, so this question Jeff's asking about, should college have the same sort of open access nature that we've seen historically with K-12 is obviously a very important contemporary one. If the returns are what you're saying are accurate, I think it's a relevant question in the current environment.
As you know, when you become you join the Fed, it's like you became a member of the Night's Watch or something. You're out of the fiscal policy business. You're out of the elections business. You're out of those. So I'm going to have an opinion about should we make college education what high school was, 100 years ago. I will just reiterate the outcomes. There's fascinating research. If you go look at the economic research, how do you tease out the causal? Is it really the schooling that gave you the return, or is this just a sign that smarter, more talented, whatever people are the ones who go to get to college anyway. Or it's just a signal, hey, you got your degree and people want to pay for the degree. They've looked at states where the state changed the rule to say the top 10% of every high school class gets to go to college, okay? And they'll look before and after they change that. And they'll show if you were at the 11th percentile versus the 9th percentile in some high school where you probably wouldn't go to college except that they put that rule in. You kind of got a truly natural experiment where they waved a random wand and somebody goes to college and it has a huge impact on them, actually even bigger than that estimated just in the averages. So I think getting skills, it doesn't have to just be college. That's the other thing to emphasize. But getting skills, manufacturing skills, service sector skills, a BA degree, that it's 21st century. I mean, it was already known in the 20th century as the young ones today say, you were alive in the 1900s? You know, and it's like, we already knew it then. And it's only gotten more true now that skill, if you want a good career trajectory, you want to be in the skills bucket. The more skills you have, the more opportunities you have. The fewer skills you have, it can still work. It's just a lot tougher path.
I've often described it, by the way, as a game of musical chairs, and there's fewer and fewer chairs for the people without skills as the labor market advances. That's really the problem, is that there are some opportunities possible, but those people without the skills, they're finding fewer and fewer opportunities in the game of the labor market. So, other questions? Yes.
So I'm going to have to go back to monetary policy. So the global financial markets are wondering, the Fed has lowered the policy rate. They're wondering, where do you think the neutral rate would be, and how far above the neutral rate do you think we have to be given the amount of inflation we still have?
Wow, getting a question from your former colleague about the neutral rate is really fascinating. So I'm curious to see how this one goes,
Okay,
Austan.
The best. I thought he was going to say, I have all central bankers rue the fact that the press, we want to talk about the economy, we want to talk about something, and they're basically like, are you going to be for rate cut at the next meeting?
Right,
how many rate cuts are you for? And I thought Jim was going to be like, so how many rate cuts are you for? But our conception of what the neutral rate is that rate at which you would not be squeezing the economy to cool it, or you would not be trying to rev it up. It's just neutral, steady state going along. And there is, of course, a disagreement about what is that, and we call that R star. What is R star? And call it, what's the terminal rate? Where are we going to land in steady state? People got mad at me. I started calling it R Sasquatch because it's unmeasurable, unknown. And then they say, oh, you missed it. And it was right there. But every 3 months, we put out the dot plot, the statement of economic projections. And they asked each of the 19 people on the FOMC, we don't talk to each other about it. What do you think the rates are going to be? What do you think the inflation rate's going to be? What do you think the unemployment rate's going to be? Or what do you think will be appropriate rates, and what will be the conditions next year, year after, in the long run? If you look at what people say the long run neutral rate is, there's a pretty wide disagreement, ranging from, I'd say, 2.5% to 3.5%. And my view is we will eventually need to figure that out, but it's a long way below where we are right now. And I think we are on path for inflation to keep coming down. I think in the long arc, the fact that we had a bump, maybe for a month or two, inflation's a little higher than what we wanted, but I still basically think the thing has come down, and this is what the path to 2% looks like. And just from a statistical perspective, you would take, I think, 25 years of monthly inflation data, given how variable the number is. It would take you 25 years of data to tell the difference between 2.0% inflation and 2.2% inflation. So we kind of got to do it by feel. Do it by feel. And it feels like to me we're headed to 2%. And we'll probably, I think it would be perfectly appropriate to, as we get to the realm of disagreement, hey, let's slow down and figure out where it is. But, I mean, loosely, I kind of think that if you looked at the average of all of those dot plots, it feels like the terminal rate that comes out of there is 3% with inflation of 2%, so for a real rate of 1%. You know, that doesn't seem out of the realm of normal.
Excellent. Thank you. Thank you. Yes.
Amy Nelson, Fair Housing Center of Central Indiana. So both of you have been talking about Indiana's market
Yeah.
doing very well, but there is a disconnect between workers and the basically have-not. Our home ownership rates here are dropping. Housing prices have not kept up with wages here, and we're also have been a target.
Other way, they've been faster than wages. Yeah, by a lot.
Yep, and we've also been a prime target for Wall Street-backed equity coming in and buying up our single-family homes. And I heard you talk education, jobs, housing always seems to get missed out, though, as being, it should be the big three there. I believe the Minneapolis Federal Reserve issued a report earlier this year about their concerns about private equity coming into the single-family market and the potential damage being done when they can control so much of that market. Individuals are having to come and basically pay cash in order to become homeowners, and there's just lack of access. What can we do out in the field to try to make sure that housing, this issue, to try to challenge what is becoming essentially monopolies at that level and how much they own now? What can we do to try to get that to be more of a national conversation?
And the big question here for the people online is really about housing policy and how that fits into the broader equation of economic growth.
And the observation that housing prices are growing faster than wages,
Right.
faster than other inflation. If you break out the inflation components, we aim for a 2% inflation rate. But even pre-COVID, it's not like the price of everything was 2% inflation. Goods prices were negative 1% deflation. Services, 3.5% inflation, 2 to 2.5%, and housing, 3 to 3.5%, 4% inflation before we got there. So now goods prices have mostly come down to the inflation rates they were before. Services approaching that. The one that's still well above the pre-period is housing. So you hear that everywhere. Some in cities, rural areas. I spoke at the Iowa Farm Bureau. I asked them, what's the biggest problem facing you here in rural Iowa? Housing costs are so high we can't get workers to come to the area. I'm not going to get into the policy. That wouldn't be appropriate for me. You know, the Fed is not, that is a fiscal policy. Congress can decide whatever they want. What you think about private equity, what you think about building permits, and should they, if you don't have supply, it's going to be hard to keep demand from driving up prices. But I want to emphasize this thing that we have been 15 plus years. It's not a new thing that the price of housing relative to the price of like what's in Costco has been diverging. Goods prices have been going down 1% a year while house prices have been going up 4 5% a year for a couple of decades now. And I don't need to tell this room, if you compound a thing at 5% a year for 15, 20 years, it's not wrong that people are like, well, my dad, bought a great house. He had one job, without a college degree, and now nobody, 2 jobs with this. You can't buy a condo. That's not wrong. Housing's gotten expensive relative to everything else. And I think you need supply. You either you're gonna have demand, partly as people have moved out of downtown offices and transformed our houses into offices. There has been an uptick in demand for residential housing. And if that's not going away, you got to supply more houses. I mean, I think that's pretty fundamental. How you do that in policy-wise, everybody's got to figure out. And it sounds like you've got an expertise and probably have a view of how they can get more affordability in housing.
Yeah, thank you. Thank you. Yes?
So the one phrase that we hear from the Fed all the time is data-driven. You wait for the data to tell you something before you act.
Now wait, that's a second. Continue, but I'm going to object to that first part.
But there are certain times when you're also hostage to fiscal policy. There's no control over it, but it impacts what you do. So theoretically speaking, if fiscal policy goes a certain way where you have tax cuts or tax hikes or whatever it is, and you know that based on past economic past results or things like that, what the kinds of things that happen, would the Fed be mandated to do things to react to that even before the impact of that shows up in the data?
Okay, you embodied 2 ideas in that question. The first part is the Fed says it's data driven. So doesn't that, my only objection was you said, so doesn't that imply that they're only allowed to look backward? Okay, no, I don't want that. That's data driven. We go around the data. It's not just all theoretical, but a lot of data are forward looking. And we should think about the economic outlook when we do the data, which led to the second part of the question, which is presuming that, well then if fiscal policy affects things, shouldn't you preemptively take action in response to anticipated fiscal actions? Okay, so from the beginning, they started asking me, are you a dove, are you a hawk? I said, look, I'm not into the birds. I'm on the data dogs. And our thing is go sniff everywhere it need to be sniffed. The data dog caucus is about data dependency, but some of that should be data that are forward looking. The economic outlook, I consider data. Inflation expectations in the market, that's data. If you have all of those things, you can be forward looking. On the fiscal policy part, the only thing is, I told you come to the Fed, you're out of the judgment on fiscal policy business. We're not going to speculate about what's going to pass, what's going to be proposed, who's going to win elections, all of that kind of thing. That's not appropriate. That's not the Fed's role. If Congress, the president, whatever, if the government enacts laws that affect the dual mandate, that is, if they affect prices, if they affect employment, we will think that through. What is the impact on the economy? Just like we think everything through. We meet every 6 weeks. Stuff's happening all the time. And our job, if you say, what keeps you up at night? Our job is not to sleep at night. That is our job. That nothing should happen that we have not thought through. We're the night's watch. We nap in the daytime. You know what I mean? When it's night, that's when we're supposed to be watching. But we shouldn't speculate on those. If it affects employment or inflation, that's when then we got to think it through. But the tariffs, fiscal, tax cuts, all of that is, it's pundits who are I predict there's a 30% chance of this thing or that thing. My view is the Fed shouldn't be in that business.
And I agree with that. Yeah, I was based my question. What I meant was, say some sort of a package is passed. The impact of the package would show up even if forward-looking data, there is a lag. So if you wait for 6 months.
Well, I mean, we run scenarios and economic outlooks, so that's kind of goes back to the first part of your question of, does data dependence means you can only wait until it actually arrives? No, and you wouldn't want it because you're kind of like your sunburn theory. Hey, oh, damn, I should have put on sunblock. I got the sunburn. Like you can't, data dependence can't mean that. Otherwise, you're going to be sunburned. Yeah.
Thank you. I thought that, yes, you were right there. Sorry.
Yeah.
Purchasing power of workers, you mean their ability to buy, just consumer behavior. Got it.
Okay. So the question about real incomes, let's call that the real income. On one stage, that is part of the puzzle that we're still teasing out at central banks. People are furious about the price level. Okay, we went through inflation. They did not like inflation. Well, inflation come back down to 2%. And we're like, oh, that's what we told you. We're going to bring this thing back to 2%. And we're doing it. People are still mad because they look at the price of eggs or the price of whatever, and they're like, it used to be less. I don't think that's that different than when, like, my grandpa used to didn't want to go to the movies because he's like, when I was a kid, going to the movies cost a nickel. And he was like, I'm not going to pay, $15 to go to the movie. And it was like, yeah, but the incomes were way less too. So the real income is kind of what should matter. Now, the argument about trying to compare incomes today to the 1970s is complicated. I hesitate to go into the weeds of price indexes and how we measure the cost of living, but in a way you got to kind of take a diversion into the cost of living to tell something about real incomes. There's a large argument within economics about that question. I will just say that the last years, during COVID and since COVID, real incomes went up. Okay, so prices are up 23% and wages are up 28%. So the real incomes should have gone up, but it didn't seem like that made people happy. And there was an economist at Harvard who did this survey, and they asked people, not how much do you like inflation, but kind of like, how much does that make you upset? Extremely horrible. Prices are up 23%. But aren't your wages up 28%? And in the survey, they were like, I deserve that. I got my 28% off of my sweat of my brow, and now you're taking it away with prices. And somehow we gotta reconcile those. But real income is what you should look at. And in periods where real income is squeezed, I'm not surprised that people are upset. They're like, my buying power is not growing. When you get change of relative prices, housing's up, but services relatively down, now it's more complicated because you can look and say, I used to be able to buy land and a big house, and now you can't. True, but you didn't used to be able to buy an 80-inch TV for $500, and so now it's kind of like depends what you value.
All right, we're short on time here, so maybe one more question. If anybody has a quick question, Yeah, I can't guarantee you'll get a quick answer, but yes, Al.
You heard that, right? That was a little dig.
That's why I turned to
You know,
Al.
I'm going to give a yes/no answer just to show you. Yeah.
All right, so Milton Friedman, I just learned, you've been at the University of Chicago for 30 years. Did you actually work with Milton? Or did you left?
He had left. I'll tell you two stories about Milton Friedman.
Well, hold on,
He-
hold on.
Oh, okay. I thought that was your question. Okay, fine. Yeah,
By the way,
yeah,
as you well know,
yeah.
I'm no economist, but I learned in economics that Milton Friedman said, after he did the big study and
Yeah.
all that, hey, all you got to worry about is M2, grow it, 2.5% a year, whatever, and the Fed should just not pay attention to anything, just grow the money supply at a certain rate, and everything will take care of itself.
That is what he said, but that wasn't a question. What was the question?
No, the question
Is money
Do you
supply?
agree with that? I do not agree with that. I do not agree with that.
do y'all pay,
Not much. So the question is, do you watch M2? Milton Friedman said, just grow the money supply. Monetarism was, if we just grow the money supply at a constant rate, that will solve all the problems. We don't need a central bank. Let's just follow the rules. Modern era of central banking, still there's a group of people who say we should follow some rules, but nobody's in the old watch M2. What is M2? M2 was a combination of cash, checking accounts, there's different money-like accounts. And as you know, financial technologies change completely. So the various monetary aggregates that Milton Friedman himself was watching, there was an argument at that time of, can you really measure it and is that appropriate? But nobody thinks now that that's measurable or an indicator. If you just look at M2 versus inflation versus the economy, the relationship broke down. So I take your point. Should we be more rules-based? We should at least look at these rules, Taylor rules, other rules, as an indicator. But just be careful, because all the rules are based on the historical experience. So when you go through periods like what we just went through, which were unprecedented in many dimensions, it's why several very smart economists got tripped up going into 2023, in which they said, looking at the historical experience, ChatGPT or any rule you want that looks at past data would have said, if you want to stop inflation, if you want to get it down, you must go drive us into the ground. Have a big recession to get inflation down. And there were major economists saying, we will have to have the unemployment rate over 6 for 5 consecutive years before inflation will come down. And it wasn't true, because the conditions were really changed. The supply side of the economy needed to heal, and its healing allowed us to get inflation down without that same kind of thing. So just be a little careful with rules. I don't want to bind our hands to the rules, but there is a lot of wisdom in the rules, so we should watch them.
Do you have a quick before we close?
It's not quick.
Oh,
so I
okay.
should
Never
skip
mind
it.
that. No.
He left in
I-
1977. I'll make
Yeah.
it somewhat quick. They're giving us a signal. But he left in 1977 because his wife hated Chicago, said it was too cold. She wanted to move to California. He'd said he just couldn't do without the intellectual environment. So he stayed to 65. They had mandatory retirement. They left. He came back my second year. I was an assistant professor. And he gave a speech that at that time, the premise was, why is Hong Kong rich and Israel is not rich? That was the topic. And his thesis was, because Hong Kong is free market, they became rich. Israel was socialist, that's why they're not rich. They had a lunch, and the faculty could come meet him. And I was starstruck. I was like, Milton Friedman himself. And I said, is it fair? Is it a fair comparison? Because, the Israel and Hong Kong was kind of the bridge to China, and Israel wasn't the bridge to anything. Like, isn't the comparison Singapore and Hong Kong, where one's more centrally planned and one's more free market, but they've both done pretty well. And then he said, young man, you don't know what the hell you're talking about. And I was like, what? And the other faculty, why did you ask that? I was like, I thought it was fair. And that was my only interaction with him himself. But when he passed away, I wrote to the New York Times. At that time, I had an economics column, and they asked me to write an obituary. And I wrote it from the perspective of economic research, that he was a giant of the field, and it wasn't about politics. And his son sent me a lovely note and was like, my dad would have loved this thing, because that's what he believed. He was a scientist, and kind of the political side was his hobby. So I felt we could all have some of the legacy of Friedman at the University of Chicago, even if he personally kind of told me I didn't know what I was talking about.
Excellent. We could go on all day. I just want to ask everyone to thank our special guests here.
Thank you so much for having me.